Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today I'm super excited to introduce a new guest to the podcast, to the channel, Andy from Finding Value Finance, very well-known guy out there on the internet. A little bit of housekeeping, guys, before we get started. Anything that we mention in today's video or on this channel is purely an opinion. Neither of us are financial advisors. Please do not confuse anything that we say today as advice. You need to seek the advice of an appropriate professional before taking any action. Anything that we talk about today is purely our opinion or for general information and entertainment purposes only. Andy, how are you, my friend?
I'm doing well. Thank you for having me on. I really appreciate it.
My pleasure. I've been a fan of your videos for quite some time now. What I might do is get you just to introduce yourself a little bit, briefly explain your background and investment style and the Platinum membership that you run, guys. I've been a subscriber to the Platinum program. It's fantastic. We'll have the details down below. Andy, what is your investment style? What is your background? And how does that relate to the membership program that you offer?
Yeah, so my background and training is actually in engineering. So I've got the mathematics, statistics type background. So I've gone through basically engineering school, came out, graduated from that, became an engineer, started looking around saying, you know what, this doesn't make that much money, at least to my wants and needs. So I dove into investing kind of head over heels. And I took maybe a little bit different approach, more of a data-driven approach. And the approach I take is basically rooted in three different areas. Those three areas are ratios, market conditions, and technical analysis. Ratios tell us where the money is at and where it isn't at. So when we do an asset versus an asset, we look and do a deep dive, maybe charting or look at history. What you'll see is a comparative valuation against two assets. And what we're looking for are those anomalies where they're cheap in comparison to history. And that should show us where our attention should be. The market conditions is what prices assets. So the ratios and the market conditions are tied together. If you look at a bunch of different ratios, it tells us about the market conditions. And how those market conditions are changing is the same thing as the ratios changing against each other over time. So if we're coming from a disinflation period to an inflation period, we should see commodities start to outperform stocks. We should start to see oil outperform gold, so on and so on. And then technical analysis is the thing that we use to validate that the market conditions are changing in our favor. So the ratios tell us it's cheap. We use technical analysis to make sure that it's changing in our favor. And what my strategy is and what my style is identifying these turning points in the markets and then investing in them and staying long for the entire cycle. I know a lot of people are trying to time things on a short-term perspective. I don't try to time things as much on the short term. I try getting the 5 to 10 year type movement out of it, where I go in very early, very cheap, ride it all the way up until the ratios become expensive or until the market conditions change where those ratios are starting to roll over. And I ride that entire move. At least that's the strategy, and that's the way I'm looking at it from my paradigm. I know a lot of people want the short term. They want the easy money. They want to go in and out and feel like they're doing things. It just seems that I don't make as much money doing that. And I don't think anyone else in the markets historically have made as much money doing that. So I've kind of refined that strategy and approach for what I think is the best strategy for making outsized returns in the least risk way to do it.
That makes a hell of a lot of sense. And if you don't mind, I'd like to delve a little bit deeper into this idea of ratio analysis, because as investors, we should be purely rational. Obviously, we're human beings, and so we're prone to emotions. But ratio, coming from that word rational, most people are only used to pricing assets in dollars or their local currency. Explain a little bit about how you have an alternative approach, perhaps, in terms of how you look to price an asset, not necessarily in dollars or local currency, but in as a ratio compared to another asset. Delve a little bit deeper into that, because that's what really attracted me to your channel, and I could look at it and say, wow, that really makes a hell of a lot of sense, especially when we're in an environment where the dollar, for instance, or any fiat currency is a floating abstraction. How are we supposed to measure an asset or measure an investment when the unit of measurement keeps changing, or in the case of the dollar, deteriorating?
Yeah, so really what matters if you're an investor is relative value. Looking at absolute value priced in dollars, that is a ratio. It's an asset priced in dollars. So the asset's the numerator, the dollar's the denominator. Um, and what I do is I take the dollar out of it. You use this in chemistry a lot when you look at ratios in chemistry. So when you look at this, you start taking out your unit of measures and taking, what I did was take the unit of measure, the dollar out, price the two assets and compared it to history. So what you're doing is it's basically level loading the two assets against each other and looking for the psychological limits that people put on this, or the bottom and top of those psychological limits of what people have priced these assets in history. So we do this all the time, and we do it across all of these different sectors and industries. If you're going to do you're going to sell your house, they're going to do a comparative analysis. They do their comps. What they'll do is they'll take a house versus a house, they'll compare it to each other, and then they get pricing. So it's an asset versus an asset, and then they get some sort of pricing out of it. What I sought out to do is I asked myself the question, if I had a 1950s car and I sold it or bought it for $1,000, how would I tell if that was expensive or cheap in 1950? And since we're not used to the dollars in 1950, what you would do is you'd look at all of the other things in 1950 and the pricing of those things. So what you're doing is you're doing a comparative analysis of this 1950s car to whatever else, assets, goods and services, the price of food, the price of whatever it is at that time. And what you're doing is you're basically comparing everything. And what I found, the easiest way to do this and the quickest way to do it to reference if something's cheap or expensive is you price an asset versus an asset, and you price them against each other and you compare it over the long-term history. And what you'll notice is that you'll see basically a valuation channel that goes sideways between undervalued, overvalued, undervalued, and so on over time. And what you could do is you could say, well, the ratio is X or the ratio is Y, and you get familiar with it. And you can say, this is cheap and this is expensive, given whatever assets they are. So the popular ones that we would price would be gold to whatever, because gold's kind of the measuring stick in the system. Gold is accounting for how much dollars is out there. The problem with pricing things in dollars is that everything can go up at the same time, and you don't know what's going up more or less without comparing them together. So what you're really doing is you're just basically finding an easier way to do a comparative analysis in history quicker. So ratios, if you're looking for a particular, if you're looking at certain assets and you want to invest in the cheapest assets in the world, you're going to have to do a comparative analysis. Ratios is that comparative analysis in the simplest way or form. You can look at it and then you can do ratios against a whole bunch of different assets. The cheapest ones will sift out through the bottom. And what you want to do is you want to focus your efforts on the cheapest ones. Then look at the market conditions of why they're cheap and when they're going to be more expensive or start to rotate, where money starts to rotate into those assets and become more expensive. So it's a way to monitor progress. It's a way to monitor how cheap it is. It kind of ties everything up. It's a way to identify the market conditions as well, all in one shot using ratios. So
Yeah, fantastic. And it's a great way to account for instance, the amount of dollars in the system. The M2 money supply has gone through the roof, especially if you compare it to your example of the 1950s. But an ounce of gold is an ounce of gold is an ounce of gold, or a barrel of oil, an ounce of silver, pound of uranium, be it, call it what you will. I'd like to get your take with a little bit of macro commentary, and you're welcome to share your screen if you've got some charts and some of those famous ratios to help prove your points. What do you expect from a macro environment moving forwards, and why? And how are you positioning your portfolio to account for that and to take advantage of some of these swings in various assets from going overvalued to undervalued that you mentioned?
Yeah, I can jump right in and give you guys a quick little tour here of what I look at. So one of the things I look at religiously, I'll call it, is the 10-year yield. And what we see in the 10-year yield, and the reason this is so important, is the 10-year yield is a function that basically derives value for all their assets. So as certain periods of time, what we see is if you got an increasing interest rate environment, like we had in the 60s, 70s, and peaked out in the early 80s, the rising interest rate environment, these are yields that we're looking at, or interest rates that we're looking at. The rising interest rate environment is an environment that does well for precious metals and for commodities. When we go into these large disinflationary periods, that is very good for bonds and stocks, because as interest rates go down, those assets get priced higher. Their net present value calculations are using lower interest rates in their returns. Therefore, more people are likely to speculate in stocks and in bonds. Obviously, they're buying bonds if interest rates are going down. And interest rates yields are inversely correlated to bond prices. So when interest rates go down, existing bonds with higher interest rates go up in value. That is all kind of unwinding right now. And what we're seeing is we've seen this impulse of inflation come. And that inflation is causing havoc on interest rates. And what is happening is the inflation was created in 2020, and it takes a little bit of time to work through the system. And it's coming through that system. We're talking about inflation from stimulus, from the constraints in the energy markets, and it is being a little bit amplified with the Russian-Ukraine conflict. But what we're seeing is we're seeing interest rates start to move up, and at a very fast pace. So as those interest rates move up, we're seeing a repricing of assets in the markets. As interest rates go up, pricing of stocks is going down for the most part, because it's a headwind as they do their net present value calculations. And it highly depends on how fast these interest rates increase for that decline in overall stock market. Stocks that use, I should say, commodities. What we're also seeing is we're seeing commodities go up. So this interest rate, the thing that's important is to get from it is, as it goes up, it's a headwind for stocks and people are selling bonds. And it's a tailwind eventually for commodities, because money's going to want to rotate into, they're going to rotate from bonds and possibly from stocks into things that are working, like precious metals eventually, and commodities. We're just very early in this game. And the big thing to take away from this chart is we've got a new shift to increasing rates and a long downtrend breakout in interest rates. So this is a big deal. And it means that we could be entering into a more inflationary period for a good long time. So that's what the interest rates are telling us. Now, if this is true, if what I'm saying is true, what we should be seeing is the ratio of commodities start to outperform stocks. So if I go to that ratio chart, and all of these are intertwined, they're not one or the other. They should all be interconnected and intertwined.
And if I just
And the
jump in
CRB,
here, I've had a question of people say, what is it that's causing people to rotate out of bonds? And is it correct to say people are rotating out of bonds, or at least the individual investor, because if your 10-year bond is giving you maybe 3.5% yield, but inflation is currently at 8.5%, you're losing purchasing power. And so people are fleeing from bonds, trying to find a new safe haven that will at least avoid the erosion of their capital. Is that what's going to drive the money out of the bond market towards commodities? Is it inflation?
yeah, so the original selling pressure comes from the inflation.
Gotcha.
As inflation is higher than, so let's just make an example up, 8% inflation and your bonds are really low. Let's say they're low at like 1%. And what you have is a real negative yield. It's minus 7% is your real negative yield. So you're losing purchasing power in that environment. And in that environment, bondholders are going to sell. And then that selling pressure, what happens is you're going to get a topping in the bond market. So what we're looking at here is 20+ year treasury bond ETFs. This is the ETF. So when we were coming into 2020, they printed all that money. Then all of a sudden we had this capitulation bottom. What a capitulation bottom is a lot of selling pressure that kind of has that one last hurrah. In this case, it's buying pressure. They had the one last hurrah, and then we had that nice good reversal. And what we're seeing is this start to roll over and decline. And then we've also broken this long-term uptrend to the downside.
And that's
And
measuring the
what
bond
this
prices, not the yields.
This is bond prices.
Cool.
Yields go up, bond prices go down. And what this is telling us is that people are selling bonds because of the inflation in the system. And once people start selling bonds, more people start selling bonds because they are losing money in they're losing principal. So when they're invested in bonds and this price starts to go lower, they're actually starting to lose money. And what happens is people get scared, they don't want to lose money, and they start selling, which then means you have higher yields, and you get this feedback loop of people selling, higher yields, more people sell, higher yields, until that cycle kind of completes itself. But what we've seen here, and with that big long-term in yield breakout, this is going to be a breakout to the downside. So we've broken this out to the downside, the upward trend line, just a simple upward trend line all the way back to 2010, showing us that we've broken out down here for the bond price. And that does have some ramifications. It doesn't mean that we just go straight lower. We very well could come back up and kind of roll back over again. The path, I don't have the crystal ball to tell you the exact path that this is necessarily going to take. But what I can tell you is we've broken the uptrend line and we've rolled over already. We can obviously have counter moves within a secular market. So we could be in a secular decline and have cyclical or short-term portions where we come back up. But overall, it is rolled over. We have broken this uptrend line, and even the Federal Reserve is looking at increasing interest rates further. So I think that bond prices are probably going to head lower in the medium to long term for a while. We could have a scare in the markets, a recession where we see bond prices firm up at some point. But that I think will be temporary. We maybe for 6 months or a year, and I don't know the exact timing of that. A lot of people like to claim that they can time these things perfectly, but I think it's a lot harder than what most people think. And if you get it wrong, there's very large negative ramifications for being on the wrong side and missing a big bull market if you're not in it. So the strategy that I've developed seeing other bull markets is to kind of ride through it. I can accumulate cash as I make it if I think that there's going to be a better buying opportunity, but I've had pretty good entry points in a lot of my buys over the years, and I'm going to hang on to it even if we do have a short-term pullback or recession. But right now, it looks favorable for bonds to continue selling off, yields to continue higher. And then looking at the CRB to S&P 500, just to kind of go back to what I was talking about there, we are still seeing a positive development in that as well. These are all interconnected. None of these are separate by its own. These entire markets are all interconnected, and it deals with money flowing around the system. So we've seen this big long-term breakout for the CRB. This is the commodities divided by the S&P 500 or stocks. And what this is telling us is that we've got a nice good breakout to the upside for commodities, breaking this long-term downtrend. And what this is telling us is that a new paradigm is coming where commodities will outperform stocks. Stocks down here at this level are vastly overpriced, and commodities are vastly underpriced at this location. Commodities have never been this cheap historically against stocks in the markets before, ever. Which makes sense because the time frame that we came from, which was a 40-year disinflationary environment, the 40-year decline in interest rates, pushed stocks higher. They printed a lot of money in the after the crash of 2008, 2009. They did all these bailouts and recapitalized the banks, but we weren't in a lending cycle. We weren't in that cycle yet. So all that money found its way into the bond market and into the stock market, which created these large imbalances in the market. These large imbalances are the opportunities for us to take advantage of. And right now, commodities, if you look, have broken that downtrend. And if I were to zoom in, we are continuing to make our way higher and higher. And, we've got these pause points. We do have some counter moves in here, but that is still bullish as long as they're facing somewhat to the downside. They're not facing upward. So usually you'll see these consolidation periods. It's not out of the normal, but it does scare people. And commodities are inherently extremely volatile, and people don't like the volatility. They don't like seeing their accounts go up and down as much. So, looking at this ratio, commodities still look good. They still look good to go higher. They still look good to outperform the S&P 500. I do have people ask questions, could these both go down at the same time? The answer is yes, they can, but you're still outperforming. You can still purchase more S&P 500, even if they're both going down, one going slower than the other. And you're still increasing your purchasing power so long that you're going down slower than everything else. You just would have been better off in that short time frame if they're both going down to be in the currency itself. But you're still increasing your purchasing power. You're still doing exactly what you should be doing as an investor, which is being able to buy more of other things. So that's kind of some major high overview of what I look at. I look at interest rates as the market conditions. I look at the ratios. I can dive into one other ratio too, just to tell you kind of what I did. What I'm going to do is I'm going to pull up the gold to oil ratio. This is gold to West Texas Intermediate crude. So what I basically painted the picture of is we said, look, the interest rates, which if you look at the bond market is what prices everything else. These are the smartest investors in the world trading with each other. These are banks and all sorts of other people that have insider information. They are painting the picture that something has changed in the bond market and that interest rates are going up. And in my opinion, that is all being caused by inflation. And what we are seeing is we're seeing everything validate that through the ratios. Commodities are starting to outperform stocks. That is validating the interest rates going up. It's all tied together. And what we should see is the gold to oil ratio start to compress lower, where oil starts to outperform gold. And what we saw historically, and what I got so excited about at the beginning of this bull market, is when the ratio came up here. Usually what this ratio does is it bounces between 10, which is expensive, and 30, which is cheap. 30 on this is down here. That is like a really, really good entry point for oil. We had a couple, an entry point here in 2016 would have been a good one, and it compressed all the way down to 15. We had another good entry point back here. But usually it trades between 30 and 10, 30 being cheap. Well,
And
the
just for
beginning of this
the
bull
listeners
market,
that are new to ratio analysis, is that saying that's measuring the amount of units of WTI to purchase 1 unit of gold? So 15 barrels
yep,
of oil per ounce and then 30 barrels of oil. Is that correct?
yep, 1 ounce of
Gotcha.
gold can buy 30 barrels of oil, correct. So what happened here is they shut down these economies and oil went to a ridiculously low price. It even went negative for a period of time, and it threw the ratio off the chart. What that basically did is gave everyone a once in a lifetime buying opportunity. And I started I couldn't go to sleep. I was so excited about it. And I bought in that entire time frame, basically as it came back down all through here. the
That's
entire time frame
amazing.
down here. So that was my, this is how I did it. I used ratios. I saw that the CRB was turning against the S&P 500. I saw inflation. I saw that we were in an expansionary phase of real estate where a demographic was coming to home buying years. That's another thing I look at from market conditions, and that's usually inflationary. Plus, they printed all this stimulus money, so it was like all stacking on top of each other. And we've broken to the downside in this ratio here. You can see this compressing down and down and down. It's not completely straight. We've got some consolidation periods, and we are coming back looking like we're doing a retest of this support down here. We very well could break higher and then come back down, kind of do a little bit of moving around down here. But I expect this ratio to continue to compress lower over time, or over this bull market over the years, and get somewhere below 10. That's the expensive ratio. And it very well could compress even further than 10 and go to 6 or something like that, potentially, if the shortages are large enough in oil. So those are some things I look at. And obviously I look at a whole bunch of different commodities as well, like uranium, copper, platinum, silver. I look at all of them, and right now the ones that I think that are cheap are uranium and platinum. Those are the two that I think are very cheap when looking at the ratios.
Okay, fantastic. So we've seen inflation being a driver for capital to leave the bond market, because obviously your purchasing power is being slaughtered while you're sitting in bonds and inflation is raging several hundred basis points higher than the bond yield. That drives that capital to move out towards sectors that are traditionally undervalued. And at the moment, we're seeing, thanks to the charts that you shared with us, commodities being the sector. In particular, oil had broken out. And now you're saying that out of commodities in general, your highest conviction sectors would be uranium and platinum. Is that fair to say?
Yeah, at this time, yes.
And is that
And
based
I'll show you.
purely off
Yeah.
of ratios, or a combination of ratios and a kind of a fundamental analysis, a logic of saying, well, uranium's trading below the cost of production, so we would expect a reversion given how inelastic the demand for energy is? Talk us through your thought process with regards to uranium and platinum.
Yeah, so I'll go over the ratios here first real quick. This is the platinum to gold ratio. We were at about over 2 times. So what that means is 1 ounce of platinum could buy over 2 ounces of gold at the previous bull market. We've come on down very low to incredibly low levels. I would say almost anomaly low levels. Anomaly being once kind of in a very long lifetime, once in a lifetime type of opportunity. And we've sold off all the way down to a ratio that means 0.54. It's about 1 ounce of gold can now buy 2 ounces of platinum. So when this reverses, you'd be making 4 times your true wealth purchasing power gains when this goes back to ratios that are historically high. These ratios are another way to tell the fundamentals. They are one of the same thing. The fundamentals, or the narrative behind it, is Volkswagen had some problems with the diesel scandal. There was a lot less diesel sales around the world, and platinum is more commonly found in catalytic converters in diesel cars. They can be used in platinum can also be used in gasoline cars, but palladium historically has been so much cheaper than platinum that they had chosen palladium as the substitute because of the cost difference between platinum and palladium. Although now, if you were to look at the platinum to palladium ratio, that ratio has changed dramatically. We've had a ratio here that peaked at 1 ounce of platinum could buy over 5 ounces of palladium, more towards its expensive level. At this time, that has declined in that market condition. The disinflationary market condition period declined all the way to 0.42. What that means is palladium can now buy multiple ounces of platinum, over 2 ounces of platinum. This is a historical anomaly as well. It's very rare to get this low. We saw it back in the 2000 timeframe, which also correlates very well to the 2020 timeframe. So the beginning of the last bull market of commodities was 99, 2000. Now we're going back into the beginning of another commodity bull cycle where platinum will most likely outperform palladium, and that outperformance will net you good purchasing power gains, not only in gold, but also in palladium. And we can see that here, that the money is in palladium and not in platinum, and platinum is extremely cheap in relationship to palladium. Platinum is also extremely cheap to silver,
Wow.
as weird as that sounds. Silver is a well-known metal by everyone who basically touts that silver is the cheapest asset in the world. And I am going to say that platinum is cheaper than silver by a long shot. So if you are a bull in silver, I would be an extremely big bull in platinum. Platinum is looking like it's ready to try to outperform silver here. Again, we're playing with statistical probabilities. I'm not playing with 100% outcome. So what you can do, or what I try to do myself, is I try to position in these cheap assets across a couple, 3, 4, 5 sectors. And what I'm hoping for is that 1 or 2 or 3 or 4, maybe even all 5, outperform given the market conditions that are coming. So platinum usually does well in an inflationary environment, and it usually outperforms the majority of it outperforms all the other metals historically. It also outperforms a lot of other investments out there as well. So platinum is a very good, we'll call it inflation hedge. So what these ratios are is that platinum is cheap against all of the other precious metals, and it's moving favorably to break out of patterns that we've seen using technical analysis. And we're just starting to break out. This is actually, in my opinion, a very good entry point for platinum. And the fundamentals, if you were to look at it from a narrative perspective, is it does well under inflationary times, and the demand supply balances out in the future are very favorable for platinum. It's used in hydrogen fuel cells. And if we go to a hydrogen type of market, like fuel cell market, platinum is going to be the limiting factor. That's what's going to be short. There's also a bunch of supply side problems that could occur very quickly. Russia produces a lot of platinum. I believe they're 20 or 30% of the world's supply of platinum. We also have shaky, we'll call it shaky electricity grids in South Africa, and the majority of platinum comes from South Africa. So there could be disruptions in South Africa as well. So if you look at the supply side, it looks kind of shaky on that side, given the Russia-Ukraine war, given South Africa and its, we'll call it the electrical grid there. There is strikes going on and all sorts of stuff. There could be riots with food or whatever it is. There could be supply disruptions, and this is probably one of the most concentrated produced supply of anything. It's very concentrated in only a couple of spots. So any supply disruptions could also send this to the roof, and a few other metals. Uranium is very similar. Whenever you price uranium, just like I did with platinum, it is cheap against everything. Uranium's got a little more kick to it in terms of its volatility and its ability to move. It's got more leverage to the price move. So a lot of people prefer uranium because of the leverage it has. Platinum has leverage too. It's a little bit different type of vehicle to invest in, physical platinum versus, say, uranium mining company or something like that. And they also have very different risk profiles between the two. So it really depends on how much risk you want to take. It depends on what type of returns or leverage you want, and they're all kind of interconnected to some degree.
That makes so much sense. It's actually fascinating to see how undervalued platinum is. It's kind of like the forgotten metal in that sense, but it's needed, as you mentioned, in catalytic conversion, but also from a medical background. I know that it's used a lot in germicides and surgical equipment. For the most part, platinum and palladium can be used interchangeably, but not when it comes to medical applications, which of course gives further demand to platinum over palladium. And when you look at in history, when platinum or when palladium has been overvalued relative to platinum, it gets to a stage where you think to yourself, well, if I can use platinum instead of palladium, it's a hell of a lot cheaper. That capital starts to buy up the platinum, and we get that ratio reversion that you mentioned.
Mhm.
So it just makes so much sense from even in a falling price environment. Nominally, all you have to do is to outcompete or to outperform relatively from one asset versus the other. Even if they're both falling nominally, you will be able to preserve your purchasing power by outperforming one asset relative to another. So it makes sense from a technical point of view using the charts that you shared. It makes sense from a fundamental supply demand situation, the geopolitical situations that you mentioned. And
Mhm.
it's kind of hard to believe that you have these investment opportunities in a few of these key sectors where they're the cheapest they've ever been relative to other assets, right at the point in time where I, for one, and I know a lot of other people do expect the demand for things like platinum and uranium to go through the roof, just in terms of our needs for those particular commodities. So that makes so much sense. And guys, if you want to learn exactly how Andy is playing these themes, join the platinum membership, and you'll get a full rundown on his positions and a deep dive. Now it's time to switch gears. It's ROI time. We're going to move to the segment that is dedicated to the concept of return on investment. And the first question I always ask guests, Andy, is what is your highest ROI from any investment to date, up until this point in time?
I think I don't know. I'd have to look to see today what the exact return is. I still own it. It's I think that it peaked out at around 35 times has been my most.
Wow.
35x. And I did it in 1.5 or 2 years. So I'll even
That's
show you the
insane.
stock. I'll show you
Absolutely.
the stock. I'll
Absolutely. We want to see that 35x in a little over a year. Everyone wants to know about that, mate.
So going back to that gold to oil ratio, what I did is I bought SM Energy. This is one of my top performing stocks for me. I bought it right here at the tip at $1.50 flat. And if I were to zoom in here, and I still own this, I am not selling it. I'll describe why. But this pattern here, if you look, there's certain things I look for in the movements of stocks. I look for large buying accumulation periods in here, and then I look for a slow kind of leak off of selling pressure to a dead period. That dead period, if you were to kind of zoom in September, October of 2020, right through here is when I said this is time to go. This is $1.50, and that's right where I loaded up. So the ratios were good. The commodity to stock ratio was turning positive. The interest rates were coming on up. And we had our first impulse move of gold that usually kicks things off for this inflationary type cycle. We had all the correct signals signaling that oil was the next to move. I also looked at the fractals of the size of this move before entering, and the fractal, these things repeat on different time frames. And let me go here. It's in this one. The fractal here is this guy where I measure it from the bottom to the top, and it's about, let's just say 600%. And I was looking at all these other companies and looking at their fractals, seeing how large their first move was, or yeah, first was. And then the pullback that they had, and I was looking and buying some of these companies that had very large fractals. SM Energy was one. I liked the background of it. It's a highly indebted company at that time, and it was sold way off given how much debt they had. They were close to bankruptcy. I mean, they were playing with it a little bit. I thought they had a little bit enough cushion to make it, and they did. And that's where I entered, was $1.50 in this kind of dead period here. I buy things with no stop losses. I just buy it, accumulate it. It moved around. It actually went all the way down to $1.30 something. And then we took off. It was a pretty fun ride after that. And this is the big kind of short squeeze. And then it kept going and going. And the reason I'm not selling out of any of this is because the conditions still exist for this to go up. So there's no reason for me to sell this at this time. And it went all the way up to a peak of, it's still going up here, $55. So whatever 55 is
Wow.
at its peak, over $1.50 was the peak I had there. I still own this though. It's at 40, about $41. We could go down in the short term, but I'm still holding it because I have the fundamentals for energy still look absolutely insane. And I think that the problems have not been solved. We're also at, I would say, a average to slightly cheap ratio. And I think that has a lot of room to compress down. This company is also dramatically undervalued, along with a lot of the other companies in this sector, because they haven't had the money flows into it like they have in the past. I think ESG and some other type stuff has been slowing some of the money flows going into this sector, which still means that it is vastly undervalued compared to history. So it's relative undervaluation right now, and where the ratio is in terms of the gold to oil ratio, we are still very cheap. We still have a long way in this commodity bull market. We still have interest rates increasing. I don't see a reason to sell at this time. This very well could go down and pull back more, but there's no reason for me to sell it. And timing the short-term movements is going to prove to be incredibly difficult. At least to me, it's incredibly difficult. And I don't know anybody who's really good at timing short-term movements, as short-term movements can be impacted by absolutely anything, any type of news, any type of whatever. What I'm playing is the structural market conditions underneath the entire market. The forces that are pushing this or pulling this higher, however you want to view it, and that structural market imbalance of demand and supply, and the underinvestment in oil and natural gas. This is more of a natural gas company. It's about 50-50, 60-40, somewhere in there. 60% natural gas, 40% oil. But that's why I continue to hold. But that's probably my best returning stock given the time frame that I've held it.
Absolutely. Well, safe to say you nailed that entry point.
Yep.
Congratulations. And I think it's important to mention that you were able to ride through some of the initial volatility. Nothing goes up or down in a straight line.
Mhm.
And so by having that conviction, you were able to withstand that initial down movement to be able to enjoy those gains over the longer term. But certainly that amount of return in such a short time frame is fantastic. What about today, Andy, as you look out into the future? What's your highest conviction stock or asset currently? And if you don't have one in particular, maybe you might mention a few names, maybe whether you like producers, developers, or explorers. What would you say your highest conviction stock is at the moment, and why?
Well, the one I like the most with the highest probable outcome and the lowest downside risk, I like uranium and platinum. I like both of those. Physical platinum has the least amount of risk with good upside potential. Physical uranium, like the Sprott or Sput fund,
Hmm.
that also has a very lower risk, good upside potential. If you want to swing for the fences and you are able to stomach a lot of volatility, and you want to push the returns and the leverage to the price move, then the uranium mining companies come into play. And I think that they are very well positioned for a big move higher. And some of those names, it highly depends on what you're looking for. For like a producer type name, Paladin Energy would be one that I would be looking at if you want a producer. The producers, they cost a little bit more, which means that their valuations are richer because they can produce. Usually you pay that upfront in terms of dollars per pound. So it's market cap of the stock versus the reserves that they have. So you're paying a richer valuation for those producers. In the developers, there's a lot of developers that are that are out there that could do very well. There's a couple in, I would say, America that I like. One of them would be Encore Energy. I do like them. I also think that they'll be developing something to produce in this cycle, which then means that the valuation of the pounds in the ground will become more expensive. You'll get a revaluation of those pounds as they start to produce, and that is value for the shareholder. That is part of the Lassonde curve. The Lassonde curve is basically where investors should be investing at certain periods. Usually that's in the exploration phase when they hit something, or the development phase where they're developing a mine, and you're gaining value for the shareholders as they add value to those shareholders through the development of the projects. So I think that that's a good one. And then I like some of the early stage developers where they haven't really developed anything, but they've done feasibility studies. They could be proving up some of the reserves still, and they have reserves. I like the Namibian assets over in Namibia. To name one, Bannerman, I think is a good one to look at. And they are higher cost producers, but I also think that they're in a jurisdiction where the most amount of people can bid for these assets. China could come in and bid, these Asian countries. You could also have European countries come in, or Japan, or somebody come in and start bidding for it. I also think that it has the least, in terms of the jurisdiction, has the least impediments for developing a project. So I think those are some good areas to look at. And the explorers, this is just swing for the fence. I'm going for it. I want to hit a grand slam. I think develop the explorers that have already hit something. They've poked a hole in the ground. They have hit something underneath. They don't know the size of this, whatever's down there. They know there's something down there. I think those have the most potential with the least amount of risk. So something like a baseload energy or a 92E or something like that.
Fantastic. And with those,
Mhm.
how are you playing? Are you expecting them to get into production and to get that multiple re-rating? Or are you more playing the game of capital flows moving into the sector? These guys have the cheapest sort of enterprise value per expected or proven and probable pounds in the ground. And if so, what would be your signal to start to exit those positions? Is that fascinating to hear? Everyone's talking about, yeah, this company, that company, their potential to get into production, their potential to be re-rated. But what's going to give us the signals to say, okay, this has gotten out of the realm of being cheap and now it's expensive relative to the risk? What do you look at in terms of coming to that conclusion?
Yeah, I look at the chart pattern, and I also look at the ratio of uranium versus gold, or uranium versus other assets. As uranium goes up and becomes expensive against other assets, it's time to rotate out of it. But we are incredibly cheap, and all of those ratios are turning positive for uranium to outperform other assets. So right now we are extremely cheap, and I don't think the bull market has progressed into a lot of these explorers yet. They're extremely low still. And I know a lot of people will look at the market cap and try to compare market cap to the old market cap of some of these companies, but you have to keep in mind that a lot of these companies have also proven their reserves well past what they were before. So a market cap, that's basically the price of the company. So they're looking at the price of history of the last bull market to the price of it is now. And let's say it's only, 50th, it's 50% of what it used to be. But they've got 270 million pounds versus nothing before. It's a big difference. So the value is what I look at. The price is just, the price of it. It doesn't mean that the market cap before is necessarily going to be the market cap in the future. And the way I'm playing this is some of them I am playing that development role. Like I said, Encore Energy is the one that I like. But the other ones, it's money flows. So it's a combination of both. And we'll see what happens and how fast this transpires, and what the charts will tell us and what the ratios will do in terms of when we're going to sell this stuff. Selling is difficult. And maybe selling in tranches is a good thing to do. I also think that this is going to be an incredibly difficult ride, and it won't be easy to ride this higher. We're going to see lots of pullbacks. They're going to be violent, and you're going to have to get emotionally ready for it. This isn't something where you're just strolling down the street and it's going to be a nice sunny day. You're going to be going down the street in monsoon hurricane force winds, holding on to poles at some point as you're going sideways, because you're going to have this volatility. And it's inherent to commodities in general, and it's just going to make it hard. But that volatility is what's going to allow you to make gains in short periods of time that you can't see anywhere else in the market. So that volatility, much like Bitcoin, was extremely volatile. It's part of the game. And you're going to have to learn to deal and cope with all that volatility if you want to be part of this game.
So true, and your charts illustrated that perfectly. It's not going to be like California weather, guys. It's going to be more like Melbourne weather, where you get at least 4 seasons in the one day. But Andy,
Yep.
thank you so much, guys. That is a fantastic education, years worth of knowledge packed into a short presentation. It'd be fascinating. I'd have to get you back in a couple of months to see how these ratios may or may not have changed. And I'd like to take a minute, guys, if you're interested in learning more about using ratios to analyze markets, and if you want to know how Andy is playing these games specifically, please join the Platinum membership. Andy, do you want to tell us a little bit about the membership, and then we'll wrap it up. And I hope to get you back in a couple of months to see how these themes have progressed.
Yeah, so there's two membership levels. There's a silver and a platinum. Silver is just like financial education. I don't update it as much in the silver membership. The platinum membership is where I spend a lot of my time. That is the membership where I share absolutely everything. You can see my portfolio, what I've overweighted. I do midweek updates. I do updates on the weekends. There's a question and answer session where you can contact me directly, just like we're speaking here. You can ask me questions. I can chart things. You can ask me about the market fundamentals. On the website, I put a lot of this information, ratio updates I put on there. I talk about it in my updates in the videos, the midweek update, and also the question and answer session. I go over a lot of information like that. I post those videos, I record them, post them on the website. I also have many posts with financial education as well, where I go through ratio investing, where I go through market balances and inventories of all these different commodities. So it's a way to, I also go over the three pillars: technical analysis, ratio investing, market conditions, and what I look for and what those things are. And I post it up there and describe in detail, basically teaching you what I know. So it's the financial education portion, it's the question and answers and the direct feedback from me, and the updates and what I'm buying, what I'm selling myself.
Fantastic. And guys, we will leave the links to all of Andy's information in the description for findingvalue.com, Twitter handle, and of course, the YouTube channel, which is fantastic. Mate, is there anything I've missed? Is there anything I should have asked you that I didn't before we wrap it up?
No, I think you had a pretty good solid foundation here of kind of what my strategy is and what I look for. So I think you've peeked into the window of what I know a little bit, at least.
Well, I certainly appreciated the journey. Thank you so much for coming on the channel, guys. Findingvalue.com, link in the description. And we'd love to have Andy back in a couple of months to see how these ratios have or have not changed. Thank you, my friend. We will catch up with you hopefully in a few months. Take care, everybody. And we'll see you in another episode of the ROI channel. Take care, guys.